Hello there and welcome. In this video I'm going to be giving you a brief overview of the video series and the strategy. Now, the strategy itself has 5 process steps, as you can see on the left hand side. The trigger candle sweep, which is our trigger to be interested in the trade, hence the name. Only when we see this trigger candle sweep do we move on to the next step in the process, which is ensuring that the direction of the trend is in our favour. We then move on to position, which means are we positioned well in the leg? We then look for momentum in our favour, so big smooth moves in our direction. And then we ensure that we're not trading into anything significant like a supply or demand zone. Now, obviously, we'll break down each individual step, but I wanted to give you a brief overview of what to expect. The theory lessons will be followed on by some practical exercises for you to complete on the charts. And once we've gone through the strategy steps, there's a video of me doing some live backtesting, and then also a video on my daily process, which enables me to watch multiple pairs and not do any morning analysis. The strategy is a purely price action based strategy using smart money concepts, but maybe not like you've seen them used before. Now, the strategy is what I like to call stone. So it's simple, it's time bound, meaning that we're not going to be on the charts for hours and hours staring at screens. There are plenty of opportunities. The principles and the concepts behind the strategy are logical and will make sense. And arguably most importantly, the strategy is mechanical and process based as much as possible. Now, personally, I trade this on the 15-minute time frame on the USD pairs, but it will work on any. You just have to go away and test that for yourself. And there is a simple way to trade this strategy and a more advanced way to trade the strategy. The simple way, which is what we are going to go through, requires no morning analysis and just requires you to follow the steps. Then the more advanced way, which is what you can move on to afterwards, will bring into play more tools like supply and demand and complete market structure, strong and weak highs and lows, and taking counter trend trades. However, those tools aren't needed to trade this strategy. They're just nice to haves and will eventually open you up to more opportunities in the market. So welcome, and I'll see you in the first technical analysis lesson, which will be the first step in our process, the trigger candle sweep. Hello and welcome to the video. We are going to be going over the first step in the strategy process, which is identifying a trigger candle sweep. So let's get straight into it. So what is a trigger candle sweep? A trigger candle has 2 characteristics, and a sweep is what that trigger candle does. So we have bullish trigger candles and bearish trigger candles. On the left hand side here, you can see a bullish trigger candle. And the 2 characteristics are that it has a big wick to the downside and a good close, meaning that the close is towards the top of the candle. Now, as a rough guide, we want to see a 30% plus wick to the downside. And we want to see no more than a 15% wick to the upside. Now, we'll go into the logic of why that is in the next slide. It's inversed for bearish, so we're looking for a wick to the upside and a good close to the downside. So they're the 2 characteristics of a trigger candle. We then look for that trigger candle to sweep liquidity, as I've indicated here by the line. Now let's just go on to what sweeps of liquidity actually are in a second, but you can see that the bullish trigger candles come in various different forms, but still maintaining the 2 characteristics, which are a wick to the downside and a good close. And same for bearish, wicks to the upside and a good close. We only want to be taking longs when we see a bullish trigger candle, and we only want to be taking shorts when we see a bearish trigger candle. So let's just go into the logic of a trigger candle sweep and why we are going to use it for our entry. So below lows and above highs, we have resting orders, sometimes known as liquidity. And the scenario we want to see is a sweep into those orders which reacts and provides fuel for a move in the opposite direction. So it'll be a sweep and a V-shaped reaction. And that's what we want to see in a bullish example. In the bearish example, exactly the same. We sweep orders above highs and then we aggressively react to the downside. Now this is going to be a trigger to be interested in the trade. And I want you to think of it like this. We're waiting for the train to come to the station and then leave before we run and jump on the back of the train. So we're already waiting for the move to happen. We're already waiting for the train to leave and go to the next stop. We're just jumping on the back. So let's have a look at a few examples of what this looks like on the charts. So there's a couple bullish examples here. As you can see with this one here, we've got a bullish trigger candle, a wick to the downside, and a good close, meaning that the close is towards the top of the candle. Now what we have to do is, to identify this straight away, is draw a box from your trigger candle open to the trigger candle low, and then drag that box up until the point price passes through. And then we're simply looking to identify a low, which we have here. And then we draw a line from that low through the trigger candle to identify a sweep. So think about what's happened. We've come down, we've took the orders from underneath here, and then aggressively reacted to the upside. Same with this example here. We draw a box from the open to the low, drag it over to the left up until the point price passes through, and then we identify a low that has been swept. We'll do an exercise after this, but I'm just getting you used to sort of seeing the visuals of this first. Another couple examples. So this one here, bullish trigger candle, big wick to the downside, a good close, draw a box from left to right up until the point price passes through, which is here, and then we have identified a low here that we've swept, that we can just draw a line straight through. And then final one here, another bullish trigger candle, big wick, good close, draw a box from right to left up until the point price passes through, which is this candle here, and then identify a low by drawing a sweep of liquidity there. Now, there are a couple scenarios that aren't valid sweeps of liquidity, and there are specifically two. So number one is when we identify a trigger candle and then we draw the box from right to left up until the point price passes through. The candle directly next to the trigger candle cannot be swept. So this is not a valid sweep. The reason for this is that we want price to come into this area and then move away. That's when we know there's going to be orders resting below that area. The second scenario is when we draw our box from right to left, we find a low like this one here, but it is higher than the candle directly next to the trigger candle. So what that means is this candle here, directly next to the trigger candle, has already taken this liquidity. So this is not a valid sweep. Let's just recap a few of those points. So there's two characteristics of a trigger candle: a big wick and a good close. And then we're looking for that trigger candle to sweep liquidity. And it will look something like this. We'll draw a box from right to left, from the open to the low, up until the point price passes through, and then we're simply looking for a low within that box. We'll then draw a line from that low through the trigger candle. And remember, there's two invalidation sweeps. One is when the candle directly next to the trigger candle is the lowest. That's not a sweep. And then the second one is when we see a low in the box, but the candle directly next to the trigger candle has already taken that liquidity, so it's not a valid sweep. Now, it's exactly the same for bearish, but everything is just inversed. So let's go through a few of these. As you can see here, we've got a bearish trigger candle, a big wick to the upside, and a good close. And then we draw a box from right to left up until the point price passes through. And then we identify our highest candle, which is this one here. So that's a valid sweep of liquidity. This one over here, bearish trigger candle again, draw a box up until the point price passes through. And then we identify our high, which is this one here. So they're both valid sweeps of liquidity. Let's have a look at a couple more. So this one here, bearish trigger candle, as you can see again, big wick, good close. We draw our box from right to left up until the point price passes through, and then we identify our high. Now when you get used to seeing these, you won't have to draw these boxes. This is just for the purpose of the illustration. And final one here, bearish trigger candle, box from right to left, and then this one here is the highest candle. So fairly straightforward and very mechanical. And same again, what's an invalid sweep? If the candle directly next to the trigger candle is the highest within that box, then that's not a sweep. And then if we find a high like this one here, but it's lower than the candle directly next to the trigger candle, then that liquidity has already been taken. So it's not a valid sweep. Let's just have a quick recap of those points again. So 2 characteristics, we're looking for a big wick to the upside on a bearish and a good close, meaning that the close is near the low of the candle. And we're looking for that candle to sweep liquidity. Now remember why this is. We're taking orders from above a high, and then we're aggressively reacting, and we're looking to jump on the train to catch the next move. And it looks like this. Draw a box from right to left up until the point price passes through, and then we identify our sweep with a line through the trigger candle. And there's 2 scenarios that are not valid sweeps. One is when the highest candle is a candle directly next to the trigger candle, and the second is when we have found a high, but the candle directly next to the trigger candle is higher, which means the liquidity has already been taken and used. So next I want us to move on to an exercise which you'll see in the next video, and it's simply to identify trigger candle sweeps on the charts. As you can see, I've done here, and I've marked out the sweeps within this price action. And once we've done that, we will move on to the next theory lesson, which is going to be market direction. Hello there, and welcome to the video. Following on from the previous theory lesson, which was trigger candle sweeps, we're going to be doing an exercise, and that is simply to identify trigger candle sweeps on the charts. So I've got a blank chart up here. This is gold on the 15-minute. The time frame or the pair used isn't too important. But what I want you to do is simply scroll to the left at some random bit of price action, and then zoom in, and we'll start identifying some trigger candle sweeps. You can follow along with exactly what I do. So we'll start here, and I'll simply move my mouse to the right, and when I come across a trigger candle sweep, which we have here, I'll just zoom in. This bullish trigger candle here, it's a big wick and a close near the top of the candle, sometimes referred to as a pin bar. But what you want to do is get your box tool and draw from the trigger candle open to the trigger candle low, and then drag the box to the left up until the point price passes through. So as you can see here, price passes through here, and then you want to simply look for a low within this box, which we have here. And then you draw your liquidity sweep using a line through the trigger candle like that. Let's move on to the next one, which is here. Bearish trigger candle, big wick, good close, So we simply get our box tool and draw from left to right, from right to left, up until the point price passes through, and then we're looking for the highest candle, which is this one here, and then we simply draw our liquidity sweep. And remember, if it's the candle directly next to it, it isn't a valid sweep. We went through that in the previous lesson. So let's move to the right. There's another one here. Bearish trigger candle, big wick, good close. So we draw a box to the left, and then we identify the high, which is there. So there we have a sweep. Let's move on. Another one here, bearish trigger candle. Does the bearish trigger candle sweep liquidity? Yes, it does, because we can see we've got a high here, and we simply draw the liquidity sweep through the high. Now, as you can see, just by doing a few random examples, this bullish trigger candle sweep here was the start of a move to the upside, and also this bearish one here was the start of the move to the downside. Let's continue. There's one here. This bullish candle here, 50% wick, good close. Now remember, we're obviously going to start adding other confluences. This is just the first step in the process. This is our entry criteria. And then we have a sweep there. Let's move to the left, to the right. Bit too much of a wick on that one, I would say. So let's continue. There's another one here, this bearish candle. So we simply draw a box from the high to the open and then drag it to the left. Do we have a sweep of liquidity? Yes, we do, which is here. So it's a very simple exercise, very mechanical. And it just allows us to start identifying these trigger candles on the charts. There's another one here, bullish trigger candle. Big wick, good close, and as you can see, this one is also the start of a move to the upside. And then we sweep that the low of that candle there. Let's do one more. Another one here, bullish, big wick, good close. That's probably around just below a 15% wick. You get used to seeing them. If you want to measure them to start with to get your eyes used to it, that's completely fine. But as you can see, we sweep that candle there. And once you get used to seeing these, you won't have to draw these boxes. It's simply just for the purpose of the exercise. So fairly straightforward. If you can go away, do that for yourself. And then when you finish, proceed on to the next theory lesson, which is the next step in the process, which is ensuring the direction is aligned in our favour. Hello and welcome to the video. This is the second step in the process, which is ensuring that the direction is aligned with our trigger candle. Now there are two parts to this theory lesson. The first part is identifying the trend, and the second part is supply and demand. Now, 80% of the time, we won't need to use supply and demand. We'll be able to see clear direction or clear control of buyers or sellers just by marking our trend. However, there will be scenarios where it's not quite clear, and we'll have to identify supply and demand levels in order to visualize the interactions between the buyers and the sellers on the charts. Now, in its simplest form, markets can move in one of three directions: upwards and be bullish, downwards and be bearish, or sideways. We are only interested in taking trades when we've got clear direction or clear control of price by buyers or sellers. Let me just touch on the logic of why this is a trend following strategy rather than a reversal strategy, and why trend following strategies put probability in our favour. And that's simply because trends continue more than trends reverse. So in this hypothetical situation here, you can see we continuously break trend to the upside, and then we have one reversal indicated by the red line, and then we continue to the downside. And that's what it will look like on the charts. We continuously break trend to the upside. We have one reversal break to the downside, and then we continue to the downside, and then we have another reversal. So in this whole price action here, we've had two reversals and continued trend multiple times. Now, what does this mean for us? Essentially, whenever we see a bullish trigger candle, like this one here, we want to see bullish price action leading up to it. Whenever we see bearish trigger candles, we want to see bearish price action leading up to it. Now, remember in the course overview video where I mentioned there's a simple way to trade this strategy, or a more advanced way? I just want to make a distinction now. So the simple way, or the way we will trade this strategy, is we will look at the most recent price action before the trigger candle printed, which is here. So here's the trigger candle, here's the sweep. This is the most recent price action. We have a break to the upside, then a retracement. So at the point we print the trigger candle, we are bullish. Now what we will see at times, and this is where we sort of step into the advanced realm, is you can see here we have this larger bullish trend making higher highs and higher lows. However, the most recent price action before this trigger candle is printed is bearish. This is what we're interested in. The most recent trend. When we start to add other concepts in, like strong and weak highs and lows and counter trend trades, that's when we'll start to look at things like this. But for now, I just want you to focus on the most recent price action. So let's have a look at a few examples. As you can see here, we're making low high, lower lows, lower high, lower low. We break to the upside. This is the one we just saw. And then we retrace and print our bullish trigger candle. So the direction is aligned. This one here, trending to the upside, high highs, high lows, high high. We retrace, we print our bullish trigger candle. So the direction is aligned. It comes in different formats, but another one here, high high, high low, high high, lower low, but then we re-break higher high to the upside, retrace, then print our bullish trigger candle sweep. Let's have a look at an example where we're not aligned. So as you can see, here is our bullish trigger candle. Here's our sweep, but the price action leading into it is bearish. What you can also see in these examples I'm showing you is that you don't need to be identifying supply and demand levels to know who's in control of price. We'll come on to that later on. Another example here, a little bit different, but lower low, lower high. And then when we print this trigger candle, I would have preferred more of a wick on this trigger candle, but just for the purpose of the illustration. A bearish example, so we've got trigger candle sweep here, and then price action leading into it. Lower low, lower high, lower low, lower high, lower low, retracement, print our trigger candle. So we're aligned in that scenario. And this one here, high high, high low, high high, high low, high high, lower low. So we're now bearish, and then we come back up, retrace, and print our bearish trigger candle sweep. And then one more, high high, high low, higher high. So we're within this range here. Anywhere within here is just noise. And then we print our bearish trigger candle. So we're not aligned in this scenario. And then this one, high high, high low, high high, higher low, high high, higher low. We're still bullish, and then we print a bearish trigger candle. Now sometimes these trades will work We just need to use more tools to be trading against the preceding trend. Now, what I want you to do is build on the previous exercise where we identified the trigger candle sweeps. And I simply just want you to identify the direction of the trend leading into the trigger candle sweep. Now, they're not always going to be clear and obvious, like the two that I've identified here, where we've got clear higher highs and higher lows in this one. And then this one here, lower lows, lower highs. Then we print our trigger candle. Now we've got two options when it's not quite clear. We can either ignore it and not take a trade, or we can start identifying some supply and demand levels in and around the trigger candle. This again will just show us the interaction between the buyers and sellers and who is in control of price. So if you continue with that exercise, there will be an exercise video next for you to follow along to, and then I'll see you after that in the next theory lesson, which will be part 2 of direction, which is supply and demand. Hello again, and welcome to the video. We're going to be going through a practical exercise and building on the previous practical exercise that we did when we marked up, in hindsight, the trigger candle sweeps. All I want us to do is simply mark the direction of price leading into the trigger candle. So I'll show you what I mean. If I get my drawing tool here, and we're simply going to mark and identify the higher highs, lower lows, higher lows, like this, lower low. We come back up and we print a bearish trigger candle. And as you can see, it is aligned with the bearish trend. So this one here is aligned. So what I'm going to do is just simply mark that with a green dot to indicate that it's aligned. And any of the ones that we do see that are aligned, we'll continue with our mechanical checklist throughout the next few videos. So this one here is also bearish, as you can see, lower low, lower high. And then we come up and print a bearish trigger candle. So this one is also aligned. And I'll simply mark that once again with a circle, green circle. Let's move on to the next one, which is this bullish trigger candle here. But as you can see, we are making higher highs, high low, break to the downside, lower low, but we break back up to the upside. And then we come down, break to the downside, put in a lower low, and at the point we printed this trigger candle, the trend was bearish. So in this example, we're not aligned. So I'll mark that with a red dot. And any of the ones we mark with red dots, we just won't continue them through the remaining steps in the process. So you've got this one here. Let's start from here. I would call this a higher high, pull back there, higher high, pull back, higher high, break to the downside. This is quite choppy, so I would call this one leg. And then we come back up and print the bullish trigger candle. So I would class that as a trade. So that one can be green. Moving on to the next. You can probably hear my clicky mouse. So this one here, let's start here. High high, big move there, higher low, one push up, higher high, and then we come back down, and because we haven't broke this low, we're still bullish. So at the time we printed this bullish trigger candle, we are bullish. So I'm simply going to mark that with a green dot. So all the ones we've currently marked green have are aligned with the first two steps in our process. And final one here, you can see I would probably call that high, high low, one big push up, and then we come back down. This is just noise. We're obviously bullish at this point in time. when we print this trigger candle. So this one is also aligned. So I'll simply mark that with another green dot. So I hope that helped. If you continue through this exercise with the chart you previously marked up, and then I will see you in the next theory lesson, which is going to be position and ensuring that we're well positioned in the leg to take trades. Hello and welcome to the video again. This is part 2 of direction, which is supply and demand. Now remember we said previously we will only need to use supply and demand zones when it's not obvious which way we're trending, or it's not obvious who is in control of price. In the examples that you can see on the screen, it's very obvious that, for example, on this first one, the bears are in control because we've had this break to the downside. We're clearly trending downwards. There are no trends within trends that we need to be concerned about that will confuse us. Same here. We're clearly bullish as we break to the upside. We're clearly making high highs and higher lows here. So there's no need to start identifying supply and demand zones. And the same with this one. We're clearly higher highs and higher lows before we print this trigger candle. And this is the reason why sometimes it might look like this. Now at first glance, this may appear to be bearish. As you can see, lower low, lower high, lower low. But sometimes what you'll see is trends within trends that will make some things like this quite complex. We could also visualize this like this. And you can look at the different reactions of price. And then when we add in supply and demand zones, we can make it even more clear. So as you can see here, you can see the interactions between price, between buyers and sellers. We have this supply zone here that breaks this structure here. We react and create another mini supply zone. We break again, although it's subtle. We come back up and interact with this supply zone, react, and then what happens? We break this supply zone. So the last thing that happened before this trigger candle here was printed was a failure of supply, which likely means that demand is now in control. And as you can see, we react from this supply zone, come back and react from this demand zone, and then we break again to continue the bullish trend and reversal. So that's just one thing you just need to be aware of. Remember, we're interested in the most recent price action, which is this here that I've highlighted. And that's simply because the last interaction here was won by the buyers and not the sellers. And there's a simple question we want to ask ourselves, and it's simply, what was broken last, a demand or a supply zone? Who's in control? And does that align with my trigger candle direction? So what does supply and demand show us in a little bit more detail? Number one, who's in control of price? Interactions between buyers and sellers, and areas where orders are being stacked. The first example is an extreme. This is what's typically taught in the SMC community, where we have a retracement and then a break of structure. And then there's normally an order block that caused the break of structure, an extreme order block of this leg. And that's what we call the extreme. Secondly, we have flips. So flips are areas where we've had an interaction between buyers and sellers, as you can see here. A reaction, and then we come back down and then we break. That leaves this flip demand zone here. That was the area where buyers took control of price. And thirdly, chains. That's just where we have a stacking of orders, whether that be buys or sells. And you'll see that in order blocks linking to other order blocks. So I'll look at some examples. So here's some extremes where we've had an order block of the extreme of the leg break structure to the downside. We retrace, create an order block, break to the downside, retrace, extreme order block, break to the downside. And you can see how these zones interact with future price action. There's a few more. Here's our order block. We break to the downside and then we come back up, interact with that zone, and then break to the downside again. Same again here. Extreme order block, break to the downside, come back up, interact with this zone. A few more examples. Extreme, break, come back up, interact, down again, extreme, break, come back up, interact. Let's have a look at a few flips. So flips, again, are areas where we've had an interaction with buyers and sellers, and either buyers or sellers have taken control. So this order block here is a demand level. We get one reaction there. We get a couple more reactions here. And then at this point here is when sellers took control and broke this demand level. And as you can see, when price comes back up, we test that area where sellers took control and we continue to the downside. Same again here. We have a clear demand zone that broke this structure here. We reacted from it once. We came up, reacted again, and then we broke. So what caused the breaker structure? It was this flip zone here. This is where sellers took control. And as you can see, we come back up, react to that area, and then continue down. Same again. Supply zone here. Price comes down. We react to that supply zone, and then buyers take control, which leaves this flip demand zone here. And then one more. We have this big order block here. 2 reactions, 1 reaction, 2 reaction, and then a break. So this flip here is where demand or buyers took control. Let's have a look at a few chains. So chains, remember, are just where orders are stacked. So as you can see here, we have this order block or supply zone. Break to the downside. We come back up, we respect it, and then break to the downside again. That creates a connection or a chain. And as you can see here, there's 3 touch points, three order blocks within this chain. Another example here, order block, multiple reactions, come up, break to the downside, pop back up, tap into this order block, break to the downside again, which creates a chain. Another one here, order block, break to the downside, come back up, tap into that order block, break to the downside again. We come back up, tap into this order block that creates a chain, and then break again to the downside. Let's have a look at some buys, some demand levels here. Break to the upside, we come back down and we we touch this area, break again, come back down, break again, which creates a chain, should I say. So how will we use supply and demand? We'll only ever need to use supply and demand when the most recent price action isn't clear. So if it's not clear to us if we're trending upwards or buyers are in control, or we're trending downwards and sellers are in control, only then will we start mapping the supply and demand zones in and around our trigger candle. And it will look something like this. Bullish trigger candle here, bullish sweep. And as you can see, I've just marked out the interaction zones between supply and demand. Same here, we've got this bearish trigger candle sweep. In this example, we wouldn't really even need to mark out the supply and demand because it's clear and obvious that we're trending downwards. But I've done it for the purpose of the example. We've got this demand zone here, and then this extreme supply zone here. Same again, we've got this supply zone here. We've reacted, demand has broken. We had a little retracement, broke again, and we break to the downside, which I've indicated with this line. React to this demand, come back up, and then our trigger candle prints within this supply zone here. So the next step is for us to continue with the exercise that we did last time, and that's simply to mark the supply and demand zones in and around our trigger candle. Now look for interactions between buyers and sellers, look for extremes, flips and chains. And again, it will look something like this. We've already marked the bearish structure on this one, but I've just identified the interactions between buyers and sellers. Same here, big supply zone, react from it multiple times, we react from it here again, and this is where we break. And then we come down, interact with this demand zone again, come back up, and then we print our bearish trigger candle within this supply zone here. And last one, this one's fairly obvious that we're bearish, so we wouldn't need to do map the supply and demand zones in this instance, but for the purpose of the example, we have this chain here which is also an extreme, and then we react to a demand zone here. I believe the next candle was a trigger candle. Just haven't got that in my screenshot. So I hope that helped. I wouldn't pay as much attention to demand zones as I would the trend, simply because 80% of the time you won't need to identify your supply and demand zones, because you'll be able to understand who's in control by looking at your trend and your structure. So proceed with that exercise, and then I will see you in the next video, which is step 3 in the process, which is position. Hello, welcome to the video. We're just going to be building on from the previous markups that we've done, where we identified our trigger candle sweeps and also direction. And we're going to be marking up our supply and demand zones in and around the trigger candle. Now remember, I just want to reiterate that we don't always need to mark up our supply and demand zones. It's only when we're not entirely sure who is in control of price, or we're not sure if price is trending upwards or downwards. So I'm going to mark some supply and demand zones up, and I will talk through my thinking and my logic as I do. I'm going to start from here somewhere. So we've got this down move before the break to the upside. So that is a demand zone. And if we follow price here, look where we're reacting. We have this down move before the break of the structure here. And then we can probably just carry that onto there like that. And then if we look at this here, price comes up, we react there, we push up, react, push up, react. So this wick here is reacting to this move here, like that. Demand zones and supply zones don't always have to be the opposite candle colour. So as an example, this one here is blue and that break structure. Sometimes it can just be a movement within the same two candle colours, like this here. You can see how price goes up, reacts, price goes up and reacts. And then you can see clearly here we've got a wick reaction to this demand zone here. And then we've also got a wick reaction here, which is this here. You won't have to do it this detailed on your markups, but I'm just going through every single one. And then we have this extreme supply here. And remember, all I'm trying to do is show the interactions between sellers and buyers. Let's just follow, let me zoom in a second. Now if we follow price here, we come down, we react to this demand zone here, we come up, we break this demand zone, and then we come back up. And this area then, although it's subtle, is a supply zone, like that. And we come up back into this supply zone, and then we have an ever so small break to the downside here, as you can see, all within this demand zone. And then we come back up and we sweep liquidity, get our trigger candle set up within this supply zone, as well as demands being broken and supplies being respected. Let's move on to the next one. So all I can simply do here is drag this supply zone over, and then we have a chain and an extreme here. And then to make this more applicable to the current price action, I can simply just drag that across there. We can delete that because we don't need it. Delete that, delete that, delete that. So for this current trigger candle, the only two demands and supplies we're interested in is this here and this here. But like I said, in this scenario, we wouldn't need it because we already know that the trend is bearish here when we come up, and also when we are here, we're bearish also, ready to go down. So it's just for the purpose of the example. Let me move on to the next one. Let's see if I can get it to stop right on the candle. Oh, how about that? Professional. Right. So what I'm seeing here straight away is this flip zone here. That's the highest candle. Sometimes I would mark, most of the time should I say, I would mark the up move, so the bullish candle here, but it's going to look a little bit stupid, so I'm going to just mark that candle there, as that's where I can see my reaction. So that's my flip. We come up, we react. That's the flip zone there, like so. And then let's just zoom in slightly. We come up to here, we react, we come up, and then we break this structure slash demand zone here, come into this zone here. So there's a supply zone that's been left here. You probably saw this in the markups in the previous theory lesson. So that's it. We've had an exchange of hands here where demand's in control. However, the last break of demand or supply was supply breaking this demand zone here. And like I say, it's very subtle, but we're only interested in the most recent thing that happened, which is this. Let's move on to the next couple. I think there's two more. So nothing's really applicable here, simply because, tell a lie, yes it is. So we have a demand zone here. There's the down move before the up move. Remember, it doesn't have to be a blue candle. It can just be an up move and down move within the same two candle colours. I would mark this simply because it's a big reaction. But typically, what you're looking for supply to do or demand is break structure. And as you can see, we react here, but demand holds. And then we get our trigger candle printed here, I think. Yes, there's our trigger candle. So demand is holding and price is trending upwards in this example. I think there's one more. Which is here. Again, not really too much applicable. The only thing I can see here, we've obviously got this demand zone here. We're miles away from it, so we don't really need to mark this up. But we'll just do it for the purpose of the example. We've got this ever so small move here. So let me just explain. We've got this here, there, to there, to there, to there, to there, and then we've come back down and touched this demand, and then continued. So it's very subtle, but it's still a demand zone. So I hope this video helped. Like I said previously, we were not always going to have to mark these supply and demand zones. For example, I wouldn't need to do it in this scenario. I wouldn't need to do it in this scenario, and there's a couple that we've previously done where we wouldn't need to do it. And I will do a more advanced supply and demand video and a more advanced market structure video a little bit later on down the line. So leading on from the previous two steps, the trigger candle sweep and then ensuring that the direction is in our favour, we have step 3, which is ensuring that we are well positioned in the leg to take trades. So what does that mean? Essentially, we want to make sure that price has retraced at least 38% of the leg we are trading. This just means we've had a decent retracement and we are well positioned to take trades. We'll use the Fibonacci tool to identify this. And in bullish examples, we'll simply draw from the previous low to the previous high, and this will give us our Fibonacci levels and tell us how far we've retraced. And in a bullish example, we want the low of the trigger candle to be below the 38, which is this line here. And in a bearish example, we'll simply draw from the previous high to the previous low, and we want our high of our trigger candle to be above the 38. And again, this just means we're positioned well, we've had a good retracement, and we're good to take trades now in the opposite direction. Let's have a look at a few examples. So as you can see on the left hand side here, we've had our bearish trigger candle sweep. We've got bearish price action. And then we simply draw from the previous high to the previous low. And this shows us that we've retraced 50%. So anywhere within this green box here, and we're positioned well. In this example here, we've had a bullish trigger candle. We've had bullish price action leading up to it. So we move on to the next step and then draw our Fibonacci tool from the low to the high. And this shows us we've retraced just above 100%. Let's have a look at a few more. Bullish trigger candle, bullish price action. Simply draw from the low to the high. And this shows us that we've retraced just over the 75%. This bearish example here, bearish trigger candle, bearish price action. Simply draw from the previous high to the previous low. And this also shows us that we've retraced 75%. Now, fairly short video because but it is very simple, and again, once again, very mechanical. So building on from the previous exercise where we marked up the trigger candle sweeps and the direction, I simply want us to go through the charts and mark up our position in the leg. Once we've done that, we'll move on to step 4 of the process, which is momentum. Hello and welcome to the video again. This should be fairly short, and we're just building on from the previous exercise we did where we marked up the trigger candle sweeps and then we marked up the direction. So now we simply just want to mark up the trigger candle position in the leg, and we'll do it like this. So let me just zoom in. On the left hand side here you have fib retracement tool. So in the bearish examples you want to identify the previous high to the previous low, and as you can see here we've retraced above the 38. For the purpose of the example, I've just highlighted the 0%, the 100% and the 38. So we're looking for bearish trigger candles to be above the 38, the high that is. Move on to the next one. Here's the previous high, down to the previous low, and again the trigger candle high is higher than the 38, so we're positioned well. And in those two trades we'll move on to the next step in the process. Moving on, this one here, remember we said this is bullish, but then we have the break of this demand zone here. Some people would consider this one leg, but I'd consider this a mini break just because we're paying attention to the most recent structure. So we draw from the high to the low, and as you can see we've retraced 38%. I think there was a couple more if I remember. It's fairly straightforward. So as you can see here, previous low, big push up to that high, and again we've retraced well past the 38%. And final one. Now a lot of people would draw the fib from here straight to the top there, and you can have a little bit of leeway with this, and that is okay. And you would probably still come down to the 38 in that example. But if you look at this here, we come up and then we do react. So that for me is a small demand zone, and it creates a higher low, and then there's one push up there. So I'm going to draw from here to here. And as you can see, once again, we've retraced more than 38%. So fairly straightforward exercise. If you can do that on your existing markups, and then in the next theory lesson, it will be step 4 in the process, which is momentum. Hello and welcome to the video. This is step 4 in the process, which is momentum. Momentum can be simply defined as the strength of the move For us, there are 3 bits of key information that we should pay attention to when looking for momentum. In bullish trades, it's the push up, the retracement, and the sweep candle itself. And for bearish trades, the push down, the retracement, and the sweep candle itself. To keep things simple for us, we want to see strength in the push up or push down in a bearish situation, and strength in the trigger candle. Strength is generally indicated by bigger, smoother candles. In an ideal situation, we want to see a corrective nature in the retracement. What we don't want to see is a retracement that looks stronger than the push up or the trigger candle in a bullish example, or the push down and the trigger candle in a bearish example. Let's have a look at a few examples. So as you can see here, bullish trigger candle sweep. Our direction is bullish as we've broke this high. We have 2 smooth candles here. And then at the pullback or the retracement is these 2 candles here with wicks either side of these 2 candles. What that's doing is a sideways corrective movement like this. And then what do? We print a very strong bullish trigger candle. There's about a 90% wick, which indicates that we've had that real aggression and V-shape. And then we don't really have a wick. Well, we have no wick to the upside. So a very good close. And as you can see, this one went on to be a big winner. Similar situation with this. Maybe not as strong in the push up, but we have push up, react here, push up. We do get some wicks to the upside, and we do get a bearish trigger candle sweep here. This candle sweeps the top of this high here. But then we get a strong reaction and a strong setup with this wick to the downside, a good body. And arguably the close could have been more towards the top of the candle. But because we've got momentum in the push up and then momentum in the trigger candle, I'd also be happy to place this trade. And as you can see, this one went also to be a big winner. And this one is nearly the perfect setup. Big, smooth push up, hardly any corrective nature or retracement within this leg at all. We have 1 candle to the downside, and then we have a perfect trigger candle that sweeps this low. About a 70% wick, no wick to the upside. And as you can see, this one went on to be a big winner too. As you can see here, smooth moves to the upside in comparison to these smaller moves in the retracement. Big smooth candle here, a lot of strength in comparison to the retracement. And then same again, this one went on to be a big winner. Let's have a look at a couple bearish examples. Big smooth move down here, retracement, big smooth move again. And then you've got these 3 or 4 candles that are just sideways moving, wicks either sides. And then we print our bearish trigger candle, once again with about an 80% wick and a very good close with no wick to the downside. And that also goes on to be a big winner. If you could spend your whole month and only trade 5 of these type of setups, you will be a profitable trader. Let's have a look at a couple more. Big smooth moves to the downside, corrective 3 or 4 candles here, and then again strong bearish trigger candle sweeps this high here, really good close. And once again, this also goes on to be a big winner. One more big sweep, big push to the downside, choppy correctiveness. There's no momentum at all in these 2 candles here. And then we get our trigger candle sweep. And as you can see here, we move to the downside. And then the candle just to the right of that second setup, we break to the downside. And then we've got these 4 or 5 candles here that hardly do anything to the upside. And then we get our strong setup and move to the downside. Let's have a look at a few examples where momentum is not in our favour. So as you can see here, we break to the downside and then we get a big smooth move, big reaction to this area here. that's an indication that you may want to stay out of the trade because there's a lot of strength in this up move. And then as you can see here, we react and then continue to the upside. Same again here. We're bullish, and then we break to the downside. We come back up, print our bearish trigger candle. But look at the reaction and the retracement. We have a bullish trigger candle here that sweeps something to the left. And then the candle after that has a lot of strength and momentum in it. So what this means is we could be just reacting to then break through. And that's exactly what we do. We react and then break through. One more example here. Break to the downside. We come back up. Bearish trigger candle. But look at the strength in the retracement in this push up from this demand zone here. And as you can see, we don't go on to break the lows. We break and go to the upside, and that would have taken our stop loss. Now, it's not always going to be obvious. I've pointed out a few obvious ones in the examples that I've used. But if it's not obvious, I would just say don't take the trade. The best setups will be obvious. And like I said before, if you stick to finding even 5 of these setups a month, you're going to be a profitable trader. Now, there's 5 steps in the process. Trigger candle sweep, direction, position, momentum, and traffic. If I was to prioritize any of them, obviously it would be trigger candle and direction, and then equally would be momentum as our number 3. So I want you to just do an exercise. Continue on from your from the previous markups and start to identify the momentum in the push down and the trigger candle in a bearish example, and the push up and trigger candle in the bullish examples. And once you've done that, I'll see you in the final theory video, which is step 5 in the process, which is traffic. Hello and welcome again. In this video, we are going to build on from the exercises we did previously, and we're going to have a look at the momentum. Now, we've done steps 1 to 3, which is trigger candle sweep, ensuring the direction's aligned, and then ensuring we are well positioned. So in terms of momentum, remember there's 3 key bits of information that we want to look at. In a bearish example, it's the push down, the retracement, and the trigger candle. And in a bullish example, it's the push up, the retracement, and the trigger candle. To keep things simple for us, we want to see strength in the push down and trigger candle in a bearish scenario, and strength in the push up and trigger candle in a bullish scenario. However, if we see strength in the retracement and it appears stronger than what we see in the trigger candle or the push down, then we may want to be cautious at that point and potentially not take a trade. Now, I obviously have the benefit of seeing these in hindsight, so I'm going to try to be as objective as possible. So let's analyze this. Our push down is from here to here. Quite smooth, nothing too alarming. And then we've also got this big push down from here. And then the retracement is just these 2 candles here. And then we get an okay trigger candle printed there. So I wouldn't be too alarmed there. There's nothing suggesting at the minute, other than demand level obviously, nothing suggesting at the minute that there's strength in this retracement. So I would move this one on to the next part of the process. Let's move on to the next one. So push down from here to here. As you can see, these 2 candles quite strong. There. Do get a little bit of correctiveness here. And then we get a strong reaction there. So at this point, I would be cautious. Up until the point we then go on to print a really strong trigger candle with a big wick and a very good close. There's hardly any wick to the downside. So I would be happy to move this one on to the next part in the process. And this is not an exact science. This is arguably the most discretionary element of the strategy, although it is still process based. So we're essentially relying on our experience to identify whether something is a strong candle or a corrective nature. Let's move on to the next one. There we go. So push down is here. This is quite smooth, but then we start getting quite corrective there. And then we get this strong-ish candle other than the wick to the upside. And then the trigger candle isn't very strong at all. It only just prints as a trigger candle. I would have preferred a bigger body somewhere down here to potentially take shorts. That coupled with the fact that we are in an overall larger, potentially bullish move, I would likely look to stay out of this one. Again, it's not an exact science. Let's move on to the next one. So this is a good example of a good setup. So we've got strength, big push up. We do have a big reaction backwards, but then we react to this demand level and again, strong push up. And then we retrace a little bit and print a strong trigger candle because it's a big wick, big body, and a really good close. There's hardly any wick to the upside. So I would be happy to move this on to the next part of the process. And if I remember right, I think there's one more just above this. Trading view doesn't stop when you tell it to. Let's have a look at this. And again, this is another good example. As you can see, the strength leading up to this area and then the final push. Really strong push. This is arguably a better setup than the previous one because there hasn't really been too much of a big reaction here. We just got this corrective sideways nature and then we print another trigger candle. Now, this trigger candle does have a small wick to the upside, but I'm still happy to take it. We've got a big body and we've got about a 40% wick to the downside. So strength in the up move, strength in the trigger candle. I'd be happy to move this one on also to the next part of the process. So I hope that helps. Go through your previous markups and have a look at the momentum. And when you've done that, I'll see you in the next theory lesson, which is going to be the final step in the process, which is traffic. Hello and welcome to the video. This is the final step in the process before we place a trade. So what is traffic? Quite simply, we don't want to be in any traffic when we place a trade, meaning we don't want our entry to be in a significant supply or demand zone. And that's the question we need to be asking ourselves. Are we in a supply or demand zone? Let's get straight into a few examples. So as you can see here, we've got this up move before this down move, which breaks this structure just to the left here. So we have this extreme supply zone. Now, this trigger candle isn't the best, but for the purpose of the example, I would have preferred a better close to the upside. But when this trigger candle prints, if we were to enter on the close of this candle, then we're in this supply zone. So that would be a no trade. Reason being, supply and demand zones are areas where price can react. So even though we may be correct in our directional bias, price can react, take out our stop loss, and then potentially continue. So what happens here is price reacts, we get our entry model, price looks like it's continuing to the upside, but then we sweep this supply zone and then continue to the downside. And here, as you can see, we get this bullish trigger candle sweep. Looks fine until you look left and realise we're in this extreme supply zone which broke this structure here. So in this example, we also wouldn't look to take a trade. And as you can see, a similar thing happens. We react, break through, come up into this supply zone here, and then move to the downside. Let's have a look at one more. We get this bullish trigger candle sweep here. So there's momentum in the push up. There's also momentum and strength in the trigger candle. So it looks good, this part of price action here. Until you then look left and realise we're in a significant supply zone here where we've had a massive reaction previously. And as you can see, price reacts to that area and then takes the stop. Have a look at a couple of examples where we're not in a supply or demand zone. So this one here, we have this demand zone, which breaks all of this structure to the left here. Price comes into this demand zone, reacts, and then we get our trigger candle sweep print there. Now, as you can see, the entry is not quite in the demand zone. So in scenarios like this, we've got a few options. We can enter the trade and just let it run, or we can enter the trade and have an aggressive break-even protocol, expecting a potential reaction from this zone. And as you can see here, that's what happens. React, come up, get our entry, and then we continue to the downside. Another example here, the most recent supply zone that we can potentially trade into is this here. This up move before this down move that breaks all of this structure. We've got a good bullish trigger candle, a good push up, and a little bit of room before we reach this supply zone. So again, we could enter this trade, go break even early, or just let it run. And in this example, we react. If we'd have gone break even, it would have come back and took us out. But if we'd have left it, we would have been in a profitable trade. Another example here. This is the nearest demand zone that breaks this structure to the left. And then when we get our bearish trigger candle, we've got a little bit of room before we reach that demand zone. And as you can see here, we get into the trade and then we have a couple reactions from this demand zone and then continue to the downside. So fairly short video. I wanted to keep this one really simple because, well, I think it can be made simple. Quite simply, when we're on this part of the process, we need to be asking ourselves if we are in a significant supply or demand zone. If we are, then stay out of the trade. So let's recap the process steps. Number one, trigger candle sweep. Remember, we're looking for a big wick and a good close. Wick, roughly 30% as a guide, and the good close, no more than a 15% wick. It may be worth doing an exercise on TradingView and just measuring a few of the trigger candles just to get used to the percentages. But once you've started identifying this a lot, they will be easy to see and you'll know your wick sizes fairly comfortably. Once we get our trigger candle sweep, we then move on to step 2, which is direction. Now remember, a lot of the time we'll understand our most immediate direction by just identifying our trend. But sometimes, if it's not clear, we can add some supply and demand zones in and around our trigger candle. And that's quite simply just to show the interactions between the buyers and the sellers to help us understand who's in control of price. And number 3, position. So of the current leg, ideally we want to retrace at least to the 38% mark. Momentum, we want to see a strong push down in a bearish example and a strong trigger candle. And in a bullish example, we want to see a strong push up and a strong trigger candle. And we don't really want to see too much strength in the retracement. And then finally, what we've just gone through, just ensure we're not in a significant supply or demand zone when we're entering the trade. If we tick all those boxes, then simply place the trade with the stop loss above and a fixed target or a logical target. We'll come on to that shortly. But one more point before I move on is that you're not always going to get perfect trades. So if you're going to prioritize any of these steps over the others, it would be these for me. And this is based on my backtesting results. So trigger candle sweep, obviously, because that's our entry. Direction and momentum, strength of the move. In a lot of my backtesting, I've saw these 3 things with not great position and sometimes in traffic, but because the strength of the trend is so strong, we've just powered through demand and supply zones. So obviously ideal trades, you want to be ticking all the boxes in this process. But if you're going to prioritize over others, then trigger candle sweep, direction, and momentum. So let's have a look at this. So remember I said previously that there's a simple way to trade this and a more advanced way. Simple probably isn't the right word, so I'll have a think how I'm going to word this in future. But when I say simple, what I mean by that is the most immediate structure to the left-hand side, like this one here. We can see the most immediate structure is bearish in this example. So in this example, we would just place a trade on the trigger candle close, stop loss above the trigger candle, and then a fixed take profit of 2R or 3R, dependent on what your backtesting results are. And then just set and forget, meaning place the trade and then leave it. It either hits your stop loss or hits your take profit. Now, if you want to be a little bit more advanced, that's when you can start taking counter immediate structure trades. That's not what we've gone through in this video series, because we need to take more into consideration to help us build a bigger picture. I've mentioned this previously: strong and weak highs and lows, liquidity, advanced supply and demand, that sort of stuff. But that's when you can also start using logical take profits or even different break-even protocols. You could even use different break-even protocols with this version, to be honest. So building on from the last exercise, if you can just go onto your charts and mark up all of the supply and demand zones in and around your trigger candle, and understand if you're in traffic when you're going to enter the trade. Now, once you've done that, there's going to be some more videos. I haven't made all of these yet, but there's going to be a backtesting video, live backtesting on a platform called FX Replay. There's going to be a backtesting in hindsight. So essentially, we can see the trades and we just mark them out on the charts without bar replay mode. There's also going to be a video on my daily process, which enables me to monitor multiple pairs, which in turn exposes me to more opportunity. There will be a video on the Discord community, which hasn't launched yet, so if you're looking for some extra support. There's going to be some videos on advanced technical analysis, so this is where we can start trading this strategy, the more advanced version, and taking counter trend trades, that sort of stuff. And then there's going to be some stuff on mindset. Hello, welcome to the video. This is the practical application of step 5, which is traffic. I've rewound price to my first example, and any of the trigger candle sweeps that didn't fit the first 4 parts of the process I've deleted. So we're just going to go through the ones that have ticked the first 4 boxes: trigger candle sweep, direction, position, and momentum. So this is the first one here. There's our trigger candle sweep. We've pretty much done this already when we did the supply and demand zones, but I'm just going to go through it again. There's our trigger candle. Are we in a significant supply or demand zone? Now, we did identify that we're in this demand zone here. So if we're being really picky, yes, we're in this demand zone here, so we could expect a reaction. Now, obviously, we've had the benefit of seeing this in hindsight because we've gone through this example a few times now, but we do react and take out where our stop would have been, which would have been above here. So that's just an example of what we were talking about in the last lesson, how we can have these reactions from demand and then we can take our stop out and then move to the downside. So let's move on to the next one. There's our trigger candle sweep there. So I'm just going to delete this, make it more applicable to the current price action, which is going to be, that's the lowest candle there. So I'm just going to drag that across. And as you can see in this example, we've reacted from it, but we're not actually in the demand zone. So this has ticked the first 4 boxes in the checklist, which is trigger candle sweep, direction, we've checked position, we've checked momentum, and now we've checked traffic, and we're not in traffic. So we would be okay in this instance to place this trade. So we'd enter there, stop would be above, and let's do 2R. We already know it hits profit anyway, but as you can see, hits profits. So let's move on to the next one. I think there's only a couple more. Trading view doesn't want to stop. There we go. There's our trigger candle. I've actually already identified the supply zones here. I was meant to delete these, but hey ho. So as you can see, this entry here isn't in a significant supply zone. So again, we'd be okay to place the trade here. This trade has ticked the first 4 boxes. It's now ticked the remaining box, which is traffic. So we'll place the trade 2%. Set and forget. And TP. And then final one. Just missed it. Just quickly go backwards. Okay. Bullish trigger candle. Met the 4 steps in the process. Final step, is it in traffic? The answer is no. So there's no supply zones here. Again, we can place this trade. Entry, stop loss just below. And to our target roughly. As you can see, another one that hits TP. Fairly straightforward exercise, I hope. If you can do that for yourselves, and then I will see you in the next video, which I think will be my daily process, which enables me to watch multiple pairs, which in turn exposes me to more opportunities in the markets. Hello, welcome to the video. I'm going to be introducing you to a second entry model that is very similar to the trigger candle entry model. And by similar, I mean it has the same characteristics. It's something I've been seeing on the charts for the past weeks and months. And I finally got around to testing it, and it's a really good entry model and will essentially open you up to double the opportunities in the market. I've called it the 2 candle entry model for now, but if after watching this video you've got any better names for it, then feel free to drop me a message. But in terms of the process steps, they will stay exactly the same. The only thing that we're now looking for 2 entry models is step number 1, so trigger candle, and now the 2 candle entry model. Let's just quickly go over a trigger candle and the characteristics as it's relevant to this new entry model also. So if you remember, in bullish examples, we're looking to sweep liquidity to the downside, aggressively react out, and we're essentially trying to jump on the train before it leaves, or just as it's leaving, should I say. And in the trigger candle entry model, there's very little resistance. It's a straight down and straight out, and vice versa for bearish examples. It's a straight up and straight down. Very little resistance. Now, just remember that as we go through this this new entry model. Now, let's get straight into it. So I'm going to go through a bullish example, and you can just assume that bearish examples, everything is inversed. So step number 1 in this new model, there are 2 candles that we're interested in. This first candle, we're looking for a sweep of liquidity and aggressive reaction out. And we see that in just a 30% wick, as you can see here. Now, this candle can be bearish or bullish. The colour does not matter. And it doesn't have to have a good close. We're just looking for the wick and sweep to the downside. Now, candle 2 is going to be our entry candle. And we're looking for it to do a certain thing. And there's a few things that make it invalidated. So what we're looking for candle 2 to do is trade above candle 1 without taking candle 1's low. So at this point in time, we have our entry and our stop loss ready, whether you want a market order or whether you want a limit order. We're just waiting on the charts now, ready to enter the trade. Now, if the next candle pushes above, we enter. It's invalidated if this candle was to push below and then push above. And it's also invalidated if it's candle number 3 or candle number 4. It has to be these first 2 candles, hence the name 2-candle entry model. So let me just run through that again. Candle number 1 is our sweeper liquidity. We're not looking for a good close, and this candle can be any colour. You've already gone through your remaining steps, and you're just waiting on the charts ready to enter. And then candle number 2 pushes above. We enter with our stop loss in the same position we would for our trigger candle, and then we play the trade out. Let's have a look at a few more examples. So this one here, high highs, high lows. We come down. I've got my candle number 1, which is a big sweep and wick. Now I'm waiting to enter, and I want the next candle to push straight above without taking the low, of which it does here. So we're in, and then we have a winner with that one there. Let's go on to a few more. This one here, high highs, high lows. We come down, we get our sweep. So we're looking for the next candle to push above to enter without breaking the low. As you can see here, just push above, we're entering the trade, and then another winner. Let's go through another one. So this is an example where the candle is bullish rather than bearish. High highs, high lows. We come back down, we sweep to the downside, but we're looking for the next candle now to push above this candle here that's swept. So we're in, and again, another winner. Granted, I've obviously picked some clean examples on the charts just for the purpose of this. So look at some bearish examples. So high highs, higher lows. We come back up, we sweep liquidity. Not a 30% wick, but it's still a liquidity sweep. So we're now waiting to enter below this candle, but we don't want the next candle to trade above. We want it to come straight down, like so. Enter, stop loss above, TP. Another example. A lot of momentum to the upside in this, so might not take this in real life on the charts, but just for the purpose of the example. So we get our sweep liquidity in candle 1. So we're now waiting. Stop loss above, entry below. Again, whether you market order or limit order, it's completely up to you. And then the next candle, we want to now take this low without taking the high, which we do here. So we'd be entering there, and then another TP. Let's have a look at another one. High highs, high lows. Sorry, lower lows, lower highs. Sorry. Higher high, lower low. So we're bearish at this point. Candle number 1, we get our big sweep. So we're ready for candle number 2 to enter just below, stop loss above. So we'd be entering here. And then again, another TP. So let's just go through, again, the characteristics and the difference between the two. So we mentioned that the trigger candle, it's an in and out, little resistance. Yeah, because it's all in that one candle. It's just straight down, straight up. Bearish example, straight up, straight down. And the 3 characteristics, we have the sweep, we have our V-shape, and we have our momentum. Now, we still have these 3 characteristics with our 2-candle entry model. However, there's potentially a little resistance, and it may look something like this. So we've come down, we've swept, we've pushed up. We may have moved sideways ever so slightly, but then we've pushed up again. So it could almost be a mark up, a little reaccumulation, and then another markup. So it's just something to be aware of. The trigger candle entry model is a lot cleaner, and this will have potentially some resistance. Now I'm going to jump onto the charts next, and we'll go through identifying some of these entry models, and then you can have a go for yourself. Hello, welcome to the video. I'm just going to go through the charts, and I've already identified essentially where entry model 2, or the 2-candle entry model, presented itself, and I'm just going to do a bit of a running commentary on them, and we'll talk through the trades. This is beginning of August, and it's the Euro US dollar on the 15-minute. So this first example here, we create high high, high low, high high, we come back down, we get our first candle here that sweeps liquidity to the downside. Now, it isn't a trigger candle because a trigger candle we would expect to be bullish at this point. But the second candle, i.e. the candle directly after this sweep candle, trades above without trading below. So we would be entering here, stop loss below this wick. And I've just put a 2% profit target for the purpose of the demonstration. Once again, trading view is very slow. I think it's because I have my screen recorder on, because when I'm going through the charts on a daily basis, this never happens. It's only when I seem to be recording a video. Okay, another example here. High, 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 low, high, high, break to the downside. We come back up. Let me just zoom in. So this first candle here, we get our sweep. Remember, we're not looking for a good close in this entry model. Get our sweep. But the candle directly after it, which is candle 2, which is this one here, trades straight below this candle 1 without trading above. So we'd be entering here, stop loss above. Let's move on to the next one. Another one here. So high, high. So we're sort of within this big range here. We get this wick to the downside that sweeps this liquidity under here. So that's candle 1. And then candle 2 trades above it straight away without taking the low. So that would have been an entry there, stop loss below. Okay, so we're creating lower lows and lower highs. We break to the upside, high, 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 low, high, high. We come back down. We get our candle number 1, which is our sweep candle, sweeping liquidity to the left. And then the next candle, we're looking for it to trade straight above without taking the low, which it does. And we enter here, stop loss below. And remember, we need this push up to happen in the second candle. If it's the third candle or the fourth candle, the trade's invalidated. And if this candle was to trade below this candle, it would also be invalidated. Let's move on to some more. I'm glad I pre-marked these out because this would take a very long time if I didn't. So another example here, high, 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 low, high, 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 low, push up. We get our candle 1 here, which is a bearish candle. We sweep liquidity. And then the candle directly next to it trades above straight away without taking the low. So that's an entry there as well. Fairly straightforward, especially as by now you will have already gone through the trigger candle entry model. It's just a subtle difference. Another example here, clearly bullish. We sweep to the downside with this candle here. In fact, this sweep can probably be there, I think. Yeah, very subtle. But we sweep this liquidity to the left, and then the next candle trades higher. This one would have been a loss, but as you can see, break to the downside. We push back up. We get our sweep candle here, and then the next candle trades below it straight away without taking the high. So we would have entered here, stop loss above. I don't think I've marked too many more, so let's just fly through this. Again, if this is going slow, just up your speed to 1.25 or 1.5. So another example here, clearly bullish. We come back down. This is candle 1 here that we sweep this liquidity to the downside, and then the candle directly next to it trades above straight away without taking the low. So we'd be entering with a stop loss below. Another example here, which would have been a loss. We're bearish, break to the downside. We come back up, probably retrace about, well, to the 78. We get our candle number 1, our sweep candle, and then the candle directly next to it here, this bearish candle trades below straight away without taking its high. So we would have been entering here with a stop loss here. And then let's just do these two now. So clearly bullish at this point in time. Here's our candle number 1 that sweeps liquidity to the left, and then the candle directly next to it takes the high straight away. So we'd have been entering there, stop loss below. And last one, we're bearish at this point in time. We have this big break to the downside. We retrace, a lot of momentum, This is our candle number 1 here that sweeps this high, and then candle number 2, trade below straight away. So entry here, stop loss above. Okay, I'm going to leave that there. Hopefully that's fairly straightforward. And I'd suggest just going onto the charts and marking up some of these entry models in hindsight to start with, and then potentially do some of your own backtesting as well. And I'll see you in the next lesson. Hello and welcome to the video. I'm going to show you my daily process, which enables me to watch multiple pairs, do no morning analysis, and only spend a maximum of 8 minutes per trading hour on the charts. This is an extremely important part of the process, and once you've learned the concepts and the strategy itself, you'll need to put a process in place to be able to trade this consistently. Now, most people will tell you to only watch 1 or 2 pairs and focus on quality. And while I do agree taking quality trades is a must, we should also be efficient with our time, meaning that in our trading window we want to expose ourselves to as many quality opportunities as possible. And I've designed this strategy and process to do exactly that. So let me walk you through it. I trade on the 15-minute time frame in the London session, which is 8 AM till around 10:30, and then sometimes in the New York session, which is 2:30 onwards. And I trade the following pairs: GU, EU, AU, USD, Swiss franc, EJ, and gold. And on each of my charts, I have some anchored text in the top corner with the process steps of the strategy as a constant reminder. Now, as we will be entering on the 15-minute trigger candle close, we need to be at the charts for 1/4 past, 1/2 past, 1/4 to, and 0:00 of every hour. So in order to make this process efficient, I have downloaded a repeat alarm app from the App Store, and that alarm goes off at 13, 28, 43 and 58 minutes past the hour. That gives me 2 minutes to come to the charts and quickly analyse and place a trade. That also means I only have to be present and focused on the charts for a maximum of 8 minutes per hour. So let me just walk you through the process. So let's imagine it's 13 minutes past 8 in the morning and my alarm has just gone off on my phone. No matter what I'm doing, I make my way to my laptop within 10-15 seconds. And I simply go through each of my pairs and see if we could potentially be having a trigger candle sweep. I'm not interested in the other steps for now. I simply just want to make sure that we're having a trigger candle sweep or not. Any of the pairs that could potentially be having a trigger candle sweep, I will simply flag with the flag icon here. So let's assume for the purpose of the example that GU, we're having a trigger candle. I'll flag that and then I'll move to EU. No trigger candle sweep there. 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 And no trigger candle sweep there. And TradingView is very slow today, but I think you get the understanding. I simply go through and mark up if I'm going to have a trigger candle sweep. At most 30-40 seconds have gone by, and I now have a minute and a half in order to go through the remaining 4 steps: direction, position, momentum and traffic, to quickly analyze and then place a trade. What I will then do is, let's assume that all the points have been met and we have a trade. Let's assume we have a trade. So I'll simply just mark it up on TradingView. On my screen to the right of me, I will have my MetaTrader 5 platform open, and I'll drag the stop loss into place ready. And then I'll simply be waiting for a good candle close. And when I get my good candle close, I enter, mark it enter. And it's as simple as that. You might think that 2 minutes isn't quite long enough to analyse the charts. And if you're new to this, maybe you want to give yourself 3 minutes with a couple, well, maybe 2 or 3 pairs rather than the 6. But once you get used to it, it's definitely ample time to be able to analyze. If you haven't watched my backtesting video yet, you'll see how I analyze the charts and the trades without any sort of morning analysis. They are completely blank charts, which is what enables me to do this. So I hope that helps. I will see you in the next video. Hello there, and welcome to this video. I'm going to be doing some backtesting on a software called FX Replay. It's very similar looking to TradingView. As you can see, it just allows us to use the same tools. I've rounded it back to January 2023, Monday the 2nd, Euro US dollar on the 15-minute time frame. Just to keep it simple, I'll stick to a take profit of 2% and a fixed stop loss above or below the trigger candle, and I won't use any break-even protocol. And we'll just go through the month of January and see how we get on. Before I do that though, I'm going to get some anchored text in the corner and just write out my process steps. So trigger candle sweep, and then direction, position, momentum, and then make sure there's no traffic. Oh, where's that gone? Right, instead of using that, I was meant to click that one there. Right, trigger, candle, sweep, direction, position, momentum, traffic. Just helps you remember the process. I'll leave that in the corner there. Right, it's 6:15, so 1, 2, 3. Should be 7 o'clock. What I'm going to do is test between 7 AM and 3 PM. I'll just go right the way through. So what time is that? That's 6:30. And let's just run through and see what we can do. I probably need to plug my battery in my Mac because it is on 10%. Should be fine for a little bit. Not liking this price action. It's very choppy, as you can see. No real direction. And what time is that? 1:15. So 1, 2, 3. That's it for that day. I'm going to quickly shoot to 7 AM the day after. Stop, and that is 6. So 1, 2, 3, 4. Remember, we don't have to do any analysis. I've got nothing marked out on my charts. All I'm looking for is a trigger candle. So we have one there. Let's just analyze this. So it's very small, but you can see it. We have a trigger candle sweep, wick, good close. Direction, the most recent direction is bearish, as you can see. So we're aligned. Reacted off that demand zone there. So trigger candle sweep, yes. Direction, yes. Position. So if we take our fib tool, go from here to the low, we've just gone between the 38 and the 50. So position, we're good. Momentum, we're also good because we have these big strong moves to the downside. Big strong moves to the downside. Now, the only thing I'm not the most keen on, but I'm still going to place this trade, is the fact that we are in a demand zone here. But I said in one of my previous videos, the trigger candle sweep, the direction and the momentum are the most important out of these. The position and the traffic, they're sort of ambers, if you like, rather than greens. So because we've got good direction going into this area, we've got position, we've got momentum, I'm going to just place this trade at there. Doesn't need any more analysis than that. 2 are right about there. and then we place it. If it wins, it wins. If it loses, and then we move on. Simple as that. So, okay, it's a good start. So that's a winner. What time are we on? We're on 7:45. Okay, let's carry on. Wow, look at that. See, if I was in this trade in real life, I'd have definitely took more than 2%. Right, let's continue. This is better price action because we're moving in a certain direction. We've got clear moves in a direction. That's what we like to see. Now, in another world, this you could take this, but I'm not that keen on it. And the reason I say that is if you look at this, watch. Down, down, go to here, down, here, back up, here. We've broke. It's a mini break, but it's still a break. So we've just broke bullish here, but as you can see, we're still very bearish here. So I'm not going to take that, but it does look like it could retrace. There we go, look. That would have been a win. Okay. We've got a sweep here. There's our trigger candle. We've already broken this area here. We've just broken this here as well. So although it, at first glance it still looks bearish, but directionally we're actually bullish. Let's just go through the criteria. Trigger candle sweep, yes, we've got that. Direction, the most immediate direction, yes, we've got that. Position, let's check. So the final push up was from there to there. So yes, we're between the 61 and the 78. So that's good. Momentum, yes, we have momentum, because remember, all we're interested in is this here versus the trigger candle, and we've got strength in both. What I also like about this trade as well is we've come down a long way, and there's all these this imbalance up here that we'll potentially go and fill at a later date. So there are reasons to take this trade, and we've gone through our criteria and everything checks out. So I'm going to place this trade with a 2R, take profit, place order. And to be honest, live, I might have even took this one as well, just because we had this mini break here. Let's see what happens. There we go, smash through target again. What time are we on? 2:30, 2 more candles. That's it, then we'll fly for the next day. 6:30. There's 7, okay. You see how we're coming back up here to fill all the orders left by this imbalance. I won't go too much into that because it'll confuse things. That's actually another one. So it's very sometimes difficult to see, but as you can see there, look, we've got a trigger candle sweep. That's number 1. Direction. Here, here, here. So we're still within this range to go higher. Now position, let's just draw the fib from the previous low to there. Yeah, we've come between the 50 and the 68. That's fine. Momentum. So I like the momentum in the push up. I'm not overly keen. I'd prefer a slightly bigger candle, maybe up to there. But we're heavily bullish in this push up, so I'm actually happy to take that. Sometimes there's a slight bit of discretion, but remember it's still process based. There is a little bit of strength in the pushback, but I've got my entry model here, so I'm going to take this trade as well, simply because we're so bullish in the price action coming up to it. So let's get the long. Two R. I preferred the other trades in terms of a setup, but this is still valid, so I'm going to take it, set and forget, and then we'll see what happens. Place. We could retrace a little bit further back, to be honest. Oh. I had a feeling that was going to happen. That's fine. We move on. It's going very slow now, my laptop. Not quite. Three o'clock. I'm just going to shoot till the next day. Right, if you just bear with me a second, rather than me stopping the recording, I'm just going to quickly grab my charger. My battery's going to run out. Right, that's better. Sorry about that. Right, where are we? 6:45, so let's carry on. It's a big sweep, but we haven't got a direction. I might even take that in another world, simply because it looks strong. In the more advanced version, I'd have probably taken that. But it's very counter trend. So there we have a trigger candle sweep, but we're actually bullish at that point. Okay, 3 o'clock, straight to the next day. So we're on the 6th of January and we're up 3%. Which is not too bad, considering we're not really doing much analysis. We're using a fixed R. Quite choppy. No, nothing really setting up at the minute. Don't like that. That's news. What time is it? It is 3:15. Okay, let's move on to the next day. What time is that? 7:15. I was just going to say, in an ideal world, you could trade that as well, but probably need a little bit more compliments. Let me just zoom into this so you can see it. Nothing really at the minute. Presenting itself again, it looks quiet. And that is 3 o'clock, I believe. Yep, next day. Can be quite laborious backtesting, but something you have to do to get used to the strategy. 6 o'clock there. Okay, so 1, 2, 3, 4. That should be 7. And let's continue. There's nothing at the minute. Price is not moving great, if I'm honest. Oh, well past 3 o'clock. Let's go to the next day. And sometimes you'll get periods of time like this where you can literally go a week without placing a trade on a particular pair. That's why I trade 6 US dollar pairs, and I've put a process in place to allow me to do that efficiently. I would talk through these trades if there were any to take, but unfortunately we're not getting our setup at the minute. I'll probably put some notes in the video description. Skip to minute 3 or something like that. Past 3 o'clock again. Okay. Horrible price action. Right. But sometimes you have to stay out of trades. Simple as that. We're still up for the month at least. If you don't get the setups, don't take the trades. It's as simple as that. Literally nothing again. There's news. Right, I'm not trading again today. Let's go to the next day. Okay. Time is it? 6. Okay, 1, 2, 3, 4. You have to excuse me if I'm quiet. I'm just trying to make sure I don't miss any candles, but while still going through it with a decent amount of speed. Looks like there's not going to be a setup again. Okay, let's move on to the next one. I mean, even if we go through the whole month and place 4 or 5 trades, let's say, and we end up 4 or 5% up, that's still a good month. I mean, I like that as a trade, but the most recent price action is bearish. There we go. Sometimes what can happen. Okay, now trades again. It's a very quiet month. Probably picked the worst month to do this, if I'm honest. Right. Look how choppy price action is here. There's no real clear direction. It's just completely and utterly sideways. Look here. That might have been nice if we had a better close, but it wasn't. When you get the good setups, you'll see them and you'll just know them straight away because you'll tick every single box. Next day. It's got to be a trade soon, surely. Come on. Oh, there we go. I nearly clicked again then, but we've got a trigger candle sweep there. So let's run through this one. Trigger candle sweep right there. Direction. We've got direction. It's quite obvious. You can see this here. Boom, 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 boom. Expectation order flow, nice and high. So we've got trigger candle. We've got direction, position. So the last push up was from here to there. So we've come back to the 61. As you can see, we've pushed up to here, pushed to here, pushed up to here, pushed to here, and then pushed right up to the top. So we've got position, so that's trigger candle sweep, direction, position, and we've got momentum. Look how big move, hardly a correction. Then we get our setup. And traffic, are we in anything significant? And the answer is no, because the supply zone is here. It's a little bit away, so we can trade into it, but we're not actually in it at the minute. So that's a valid trade. So long, stop below, fixed R of 2, which just takes us into that supply. I would have preferred that to have been lower, but we'll take it anyway. Place order, save. Has that not worked? Place order. Oh yeah, it has worked. And there we go. Smash through target. So you can see momentum is really, really important. Again, trigger candle sweep, direction and momentum are the most important ones. Let's move on to the next one. What's that? 5% in 18 days. Not too bad. Pretty boring because we only placed like what, 4 trades. But I would rather take quality than quantity. Oh, past 3 o'clock. Let's continue. $6.30. Yeah, I'm definitely going to put timestamps at the bottom of this video just so you can fast forward, because you don't really want to be watching me going through all these candles and not placing trade for about 2 weeks. It's a bit boring, isn't it? Okay, let's analyze this a second. So we have a trigger candle sweep there. There's our sweep. There's our trigger candle. We have direction. Last push up. There, 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 there. So hopefully there. Now, momentum, position. So the last push up was from here. In fact, no. The last push up was here to here. So we've come back to the 78 there. We've got position. Momentum, let's have a look. So we've got obviously a push up, and then we're quite corrective, and then we get our candle, which is good. The only thing I don't like, but I'm still going to take the trade, is we are in a big supply zone here. But we haven't really had a reaction from the supply zone. It's almost just stopped and price has gone sideways. So this is where you have to apply a little bit of trader as well. I'm going to take this trade. It could just smack us right back and take us out, but I'm going to take it. I've hit 4 of my points. And remember, momentum, direction, and trigger candle sweep are more important than the others. So let's see what happens. Place trade. Oh dear me. It's going to be a loss. Yeah, there we go. Not to worry, let's carry on. That does sort of just prove that, you know, when you are in and around a supply area like this and you don't tick all the boxes, you can take some losses like that. Right, let's go to next day. That's a shame. Beautiful one there. It's 7 o'clock, okay. Ooh, this is interesting. So let's just put a sweep. I'd prefer the better close, but we are still within 15% from the low. Now, we've had the break of this demand here to the downside, so let's just follow price. Here to here to here, and then we break down to here, I would say. Then we come back up to there. So that's actually valid. So we've got direction, we've got the trigger candle sweep, position, the last leg from there to there. Again, it's not the best setup, but we come back to the 78 there. Momentum, we have got quite a strong push from here to here, but we've got an equal strong push upwards here as well. So it's not the cleanest setup, but for the purpose of this, I'm going to take it because oh, and sorry, traffic as well. So supply zone or demand zone, got a demand zone there. We could be reacting from it, coming back up, sweeping liquidity to take the low. So we're not quite in it, we're more reacting from it. So emotionless, place the trade, take profit, stop loss, and we'll see what happens. It's very slow, very, very slow. It's going to come back on us. There we go. So there's a win again. So what we're on, 6.3%. And we're at 3 o'clock. So let's move to the next day. Price is starting to move a bit better now. We're actually getting some direction rather than just choppy sideways action. going to say it's a shame that one there, that candle didn't have a better close, because I've taken that because it's bearish leading into it. We've got a sweep. Well past 3 o'clock. So we're on the 20, just coming up to the 24th. We'll just do the month, and at least that's giving you some sort of idea of what we do when we trade this. No analysis, we just come, wait for our trigger candle, and go for our list. And as you can see by some of the trades I've taken, I've not had everything perfect. I've just prioritised the ones I said: trigger candle, the direction, and the momentum more than anything. Do get a trigger candle sweep there, but it's not entirely clear. So we've got direction like this, here, 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 break to the upside. So it's fair to say the most recent price action, I would say, is bullish there. And if you look, momentum, we've got this bullish momentum here, and coupled with that, we're actually in a quite a choppy area there. So this could quite easily work out, but I'm going to stay out of this one. It would have taken us over a loss. See how it reacted to this zone where we had multiple reactions. Right, past 3 o'clock. Let's move to the 25th. I do hope this is still recording. I mean, doesn't look like a bad trade, but if we were following our rules, the most recent price action again is bullish. But this could indeed take the lows. Nope. Okay, let's move on to the 26th. Right, that's a trade. I can tell that already. So there's our sweep. There's our trigger candle, bearish. There's our break to the downside. So let's just do the direction. Like this, like this, like this. Break to the downside. So we're coming back up potentially to take the lows. So trigger candle sweep, yes. Direction, yes. Position, yes. It's going to be 75. High to the low. We've retraced over 78, sorry, not 75. Momentum, I'm very happy with the momentum. We've got big, strong move, push down, and then we've got a strong trigger candle. We do also have a strong reaction, a strong bullish reaction too, but I'm still happy to take this trade. And then traffic, we're not really in a, you could say we're in this choppy area here, but we've already had a break to the downside of this. If this didn't break, I wouldn't take it. So I'm going to place the trade. and go there, and 2%, place order, save. Okay. There we go, TP. So that's 8.4%. We've got a few days left. Let's fly through those. And bearing in mind, this is just one pair, and we're being really picky about the trades that we're taking. So you imagine we're doing this across 6 pairs. There's just a lot of opportunity, and especially if you start trading the more advanced way, where you can start taking counter trend trades and stuff like that. As an example, this one here. See that? We'll get a sweep. Well, not quite, but here would be a good example. See this trigger candle sweep here? We're sweeping all the liquidity. I would take that if I saw that, but obviously it doesn't fit our plan. So let's carry on anyway. What time is it? 2 o'clock. Okay, let's fly to the next day. There we go. 27th. It's 3 o'clock. Let's go to the next day. Probably about 2 days left, I think. Not quite a sweep. So we have a trigger candle sweep here. Let's go through the list. We've got a trigger candle sweep. We've got direction. As you can see, we've got this big push up here. And then we've pulled back and swept. Position. I don't think we're going to have good position, but still. Yeah, it doesn't quite come back to the 38. It's probably going to come back to the 23, which I haven't got shown. But remember, position is more one of the ambers rather than the absolutes. And then we are actually in traffic here. We've got this supply zone. Let's drag that to the side. But again, we've almost reacted from it. Come back down, and they're potentially ready to take it. The main three, like I said, trigger candle, direction, and momentum. We have all of those. So I'm going to place this trade with a 2R target. We have got to do a little bit of work because we're in this supply zone here. It's not ideal, but I do like the momentum coming into this area. So let's just see what happens. I'm not going to win them all, but as long as we're applying the same logic to them all and executing, we're going to be profitable over time. And the beautiful thing about the strategy is it is process based, and the entry model, especially the first one, it's a yes or a no. There's no sort of in between or discretion. All right, so let's place that. Well, that needs to change to 15 again. And there we go, another win. I don't know why that says 15%, because I think it might have reached 2% on that last trade. Let's just have a quick look. Close positions. We'll just go through the wins and losses in a second. Right, what time is it? It is 10 o'clock. Let's move on. Not quite a sweep. 3 o'clock. I think we've got one more day left. So let's see if we get anything. I'm not sure how long this video has been either, to be honest. 45 minutes, an hour maybe. Hope it's not too boring to watch. Right. There's true candle sweep, but we're bearish at that point in time. So it's got a good bit of momentum in it. Let's follow this down. This is what I do when I'm trading the charts. I just talk to myself all day. Trading drives you crazy, if you didn't know. This is a setup. So, got our true candle sweep there. We've broke this here. We are bearish on this sort of larger trend here, but we have broke to the upside here. So the most recent price action is bullish. So we've got our true candle sweep, we've got direction. Come back up, swept. Position. The last push up. There to there. To there. To there. It's actually going to be like 100% because that's sort of the last push there. So it's retraced 100%. But like I said, I'm more happy with the momentum coming into it rather than the position. And then traffic. Here's the nearest supply zone. There's quite a bit to go to that. It's quite a small trigger candle as well. But I'm going to place it. And let's see what happens. Be nice if 2R is before that that supply zone, which it is. Place order. Set and forget. Let's see what happens. Gonna be a loss. Oh, there we go. Thought that was going to be a loss, but it was a winner. And that's it. There's January done. Don't quite think it's 18% because I think some of those trades have risked 2%. But let's just go through and count how many wins and losses there have been. 1, 2, 3, 4, 5, 6, 7. 7 wins, 1, 2, 2 losses. So 7 wins and 2 losses. Let me just quickly get my calculator. Work out the hit rate for that month. So 7 wins over 9 times 100, 77% hit rate, which isn't too bad at all. So I hope that video helped. You got any questions, just drop me a message and I'll get back to you. Hello and welcome. In this video, I'm going to talk you through exactly how I collect data for this strategy. Now, collecting data is a must, and you simply cannot afford to skip this part of the process. And that's for a number of reasons. Firstly, you need to build confidence in the strategy, in yourself to trade the strategy. You also need to have an understanding of some key metrics. So, as an example, your hit rate or your strike rate, which essentially means as a percentage, how often do you win? The maximum percentage or the maximum R each of your trades went before then taking you out for a loss. How well does the strategy perform in certain sessions? Frankfurt, New York, London. How well does it perform in certain conditions or situations? So, for example, let's say we have a trigger candle sweep, we have direction, we have momentum, but we're in traffic. How well does the strategy perform in that scenario? So I'm going to talk you through my data sheet. We'll go through a few examples and I'll show you what you can do with some of those key figures once you have them. And once we've done, you'll be able to download a blank Excel data collection sheet below this video. So let's get into it. So this is my data sheet. I use Google Drive and I have a number of different tabs for a number of different strategies. And I've simply got my 5 process steps as a constant reminder on the data sheet. And let's just walk left to right. Some of these are going to be obviously fairly explanatory, self-explanatory. So month the trade was placed, trade number, the date, the entry time. So as an example, this top one here, if the entry time was 14:00, then the trigger candle would have been the 1:45 trigger candle. Direction, long or short. Now, this one we haven't gone through yet, but I'll just give a brief explanation. So, whether we are pro or counter the swing structure. So, when I talk about swing structure, let me just delete this, because I was going to explain it, but it's best to just draw it, I think, and do it again. So, we did say that when we trade this strategy, we want to be, so if we want to trade long, we're looking for bullish price action, but we're also looking for bullish trigger candle lead, and bullish price action leading up to that bullish trigger candle. When we talk about swing structure, on each of the pairs, you'll see a larger trend and more of an internal trend. So the larger trend is what we call swing structure. So in this example, hypothetical, swing structure is bullish, the internal structure is also bullish. So you don't need to know the swing structure, whether it's pro or counter, to trade this strategy. It's just a nice to have. And that's what this column is showing here. This column here is maximum R. So what was the furthest that the trade went before it then came and took us out for a loss? So this example here, this long at 2 o'clock, did 4.1 R or 4.1% before then coming back and taking us out for a loss. This section here essentially means if the trade went 1R, I'd mark that as a 1. If it went 2, 2, 3, 4, and if it went 5, 5. As you can see here, though, this one only done 4.1R. So this last column here, 5, was -1, meaning that if we'd have set our profit target for a 5%, it would have been a loss. And you'll see at the bottom shortly, we can do a sum to add all of these up. And that will just tell us what R or what percentage target would have been best over the time period that we have tested. Now this section here is essentially the 5 steps of the process. This column, trigger candle. Do we have a trigger candle sweep? Now you'll notice some ambers on here. And that's because personally I allow myself a little bit more discretion. But for the purpose of this example, I'm just going to mark this green. So this is showing all of the trigger candle sweeps. This second column here is direction. Is the direction aligned? Same again, I allow myself some discretion with some counter trend trades. But again, for the purpose of this, I'll just highlight this green. So what that's now showing is we've had our trigger candle sweeps and then directions aligned. Now, these 3 columns here are momentum. Now, let me just do a quick recap, because this is quite important. So remember, in bullish scenarios, we said that we have the push up, we have the retracement, and then we also have the trigger candle itself. So we essentially have 3 bits of information. We have 1, we have 2, and then we have 3. And obviously for bearish trades and examples, it's just inversed. So what I've done for each of my trades, so this one here, this is a comparison of momentum between the sweep versus the pullback. So let me just delete that. So I've done a comparison when I placed a trade of the sweep, which is this here, versus the pullback. Now, if the sweep was, or should I say, if it showed more strength than the pullback, I would simply mark it green. So if this here looked stronger than this, then I would simply mark it green. And again, this is slightly discretionary, but I've tried to make it as process-based as possible. If they were equal, I would mark it as an amber. And if the retracement looked stronger than the trigger candle, I would mark it as a red. This column here is essentially the sweep versus the push, and we're simply looking for strength in both. So all of these will be green because that's one of the criteria for the trade. So that is essentially looking at this here, the push and the sweep. And if you remember in the strategy video, to keep it simple, to start with, we just want to look for strength in the push up and the trigger candle in a bullish example, and strength in the push down and the trigger candle in a bearish example. If I did see strength in both of those, I would simply mark this as a green. This column here is the pullback versus the push. So let's just delete this. So the pullback, which is this, versus the push up. And again, doing a comparison. And for it to be green, I want to see more strength in the push than the retracement. If I see equal strength in the push and the retracement, I'll mark it amber. If I see more strength in the retracement and the push, I would mark it red. So ideal trades, we'd obviously have 3 greens in these columns. So that means the sweep is stronger than the retracement. The push is stronger than the retracement. And we also have equal strength or good strength in the push up and the trigger candle. Position. So we spoke about position. That's simply the retracement, how far I've retraced as a percentage. We use our Fibonacci tool. That's this column here. And then the final one is traffic. Now, there's a couple different scenarios with traffic, and I've identified them here. So number 1, we're not in traffic at all. Number 2, the entry is in traffic, identified in red. Number 3 is we are reacting to traffic. So let me just give you an example. So let's say we've got a supply zone here. Let's say we've just printed a bullish trigger candle sweep here, but we're not quite in the supply zone. We've reacted and then we've printed our entry. In that scenario, I'd mark it amber, like this. As you can see, a number of ambers there. And then this scenario here, traffic within 2R. So what that means is let's say we print a bullish trigger candle here, but the nearest supply is less than 2R away. So let's just do a hypothetical example here. So as you can see, this supply zone in this hypothetical example is 1.1R away. So we've not reacted from it, we're not in it, we're approaching it. And I would mark that as yellow, which is this here. And then simply a comment section, and then just screenshots of each of the trades, as you can see here. So that's a walkthrough of the sheet. What you can obviously then do, so let me just scroll down to the bottom, is you can start to play about with the data. So equals sum of all of these here. Enter. Let me move them over. And you can get some really good information. So as an example, if we'd set a profit target of 1R for all of our trades for this time period, which was 2023 and a couple months of 2024, I believe, then it would have been 37. But if we'd have set a profit target for 2R, it would have been 69%. And then you can start to say, right, okay, let's look at all the perfect trades. So all greens. And then let's get rid of anything that's retraced 100. Let's get rid of the 23s. And then you can start to let's go back a second. Filter by colour, greens. And then you can start to look at all the perfect trades and see how the perfect trades got on, which obviously there wasn't many in this scenario where we've had every single box ticked. Green. But when we do look at all these. That's like a 90% hit rate at 2R. It just shows you, as an example, what you can do with the different parts of this data sheet. What you can also do then is work out your hit rates as well. So let's just, for argument's sake, let's just say 2R. I'm just going to do a quick calculation. So 60 count, so 30 wins. There is an easier way to do this, but I'm going to do it manually now just to show you. So 30 wins and 38 losses, which is there. So if we're doing a calculation of working out our hit rate, it's 30 divided by 68. So the wins divided by the total. So our hit rate at 2R is, for this data set with these filters, is 44%. Now, what you can do once you've got that figure is the following. So online you will find a number of different equity curve simulators where you can input figures like this. So as an example, we'll walk through this one. So let's say we started with 100k count. The win probability was 44%. Win-loss ratio was 2 to 1. So that's the data we've just analysed. And let's say 10 trades for the month. Risk 1%. And then you simply start simulation. And it will tell you, in fact, let's do a bigger sample. Let's just say 100. And it will show you a number of different scenarios where 44% is your win probability. And your win-loss ratio is 2 to 1. As you can see here, you can click this multiple times and it will show you different simulations. And here's some different performance indicators. So what's your max drawdown? What's your average performance? How many consecutive winners? How many consecutive losers? And then you can start to get an understanding of how your strategy could perform in the future if you trade it well. So I think that's pretty much it. I'll leave a blank data collection sheet below this video, and I'll see you in the next video. And welcome to the video. Today's date is the 2nd of September 2024, and I'm pleased to announce that the Discord community has today gone live. So I'm just going to spend a couple minutes talking you through exactly what you can expect if you want some extra support. In terms of goals for the community, I guess number one is fairly obvious, and that is to create profitable, consistent and funded traders. Number two is to deliver a personalised service to a small group, and that is less than 10 to start with. What I really don't want to be doing is doing big marketing campaigns and getting 20, 30, 40 people join up straight away, where I can't really provide quality support. I want to keep the numbers really low to start with and build a core group of traders. And thirdly is just to create a supportive and a welcoming community. In terms of what you can expect, firstly, you'll get direct access to me where I'll be responsive. So I'm on the charts from 7:45 in the morning up until around 10:30 during London session. And then I go to the gym for a couple hours. And then sometimes I trade the evening session. So if you've got any questions or queries and you post them during the day, I will get back to you as soon as possible. So I'm planning to be as responsive as possible. Secondly, daily morning analysis markups. So before the start of the trading day, I mark up each one of my pairs and essentially try to look and build the narrative on that pair. So where could price be going? Who's in control of price? Answering those sort of questions. There'll be daily end of day markups where I will analyse the charts and look at what trades were present during the day, what we missed, what we took. There'll be live backtesting sessions. There'll be new videos updated regularly, and there'll also be ad hoc Zoom and trading floor calls. And just a disclaimer, it's not a signal service, and you can also cancel at any time. So let me just walk you through each of the different sections. So if you're familiar with Discord, you have sort of a start here section where I've just gave a brief overview of what to expect and what's contained in each of the pages. There's a disclaimer there. You don't have to sign anything, but it's just sort of something you can read. Community values. Try to keep it fairly simple. Just be kind, be supportive. No question's a stupid question, and we're all here for the same reason, which is to learn, earn, and support each other. There's an announcement section which will be read only to you, where I'll post any announcements when I upload new videos or when we've got scheduled calls. The section to introduce yourself if you want to do that. And then I'm trying to keep it really clean and simple at the minute. So there's one chat, and there's also a section where you can potentially share your trades if you want to do that also. And these two sections here are read only. Morning analysis is where I will post my morning markups, like so. And you can either copy me or check that you've done yours correctly. And then daily markups is where I will post the end of day trades for each of the pairs. And then there's also a section to ask for support. Now, in terms of price, for the first 10 people, it's going to stay at £45 per month, which I think is very reasonable considering I'm going to be giving a lot of time to those first 10 people. And then after that, it will rise, but I'm not exactly sure what it's going to rise to yet. I will put a link underneath this video, a direct link, and if it's something you're interested in, feel free to join.